Hi guys, welcome back to Father and Son Investing. Today's video is the March 2025 Treasury Bill update. There's something interesting happening in the Treasury Bill market if you're not aware of it. Let's take a look at this headline here. It's talking about the 6.4 trillion T-bill market, but I want to point you to the sub-headline. Yields are rising on Treasury bills that mature in late July and August when the debt ceiling fight is expected to come to a head. That debt ceiling sometimes gets the name of X date, meaning that is the date when the government will not be able to pay all of its obligations. Just when is the X date? We don't know exactly because the Treasury has some extraordinary measures that they can use to keep funding the government even when their Treasury account runs dry. But looking at this graphic here, we can see that it's projected to occur sometime between June and September. That all depends on what the inflow of cash looks like for the Treasury in the month of April. When tax receipts are coming in, that tends to be a good month for the Treasury. However, May tends to be a very budget unfriendly month for the Treasury, where spending is more than what they're receiving in revenue. June is kind of questionable because there are some payments that will come due to the Treasury in June, those quarterly payments, but the Treasury also has some significant expenses also due in the month of June. So going back to this article, let's just take a peek graphically at what they're talking about for late July and August. This is the graph I want to show you. You'll notice that for Treasury bills that mature here, starting really kind of June, July, August, especially this late July and August, we'll see kind of an uptick here. Now, granted, it's not a lot. We're looking at 4.32% versus up to about 4.38%. And the reason I think this doesn't look like a lot yet is there's some things happening in the U.S. House and the U.S. Senate that are affecting this. This headline here from NPR tells us that the Senate adopted a budget resolution after a marathon vote-a-rama. The Senate's version of the budget resolution did not cover taxes. However, the House also recently passed their budget resolution, and it includes everything, not just the border, not just military spending. It also includes everything the Trump administration was trying to do, including tax deductions. Now, the problem here is that in order to get all of this passed through, the Senate and the House have to agree to the same bill. Now, you may recall that the House version of the budget narrowly passed 217 to 215, with one Republican not voting for that version of this budget. So my understanding of what will happen next is that the House version of this budget will go to the Senate, where the Senate will try to make these tax cuts permanent rather than just for 8 years. That then would go back to the House. And the question is, will all of these congressmen be willing to sign off on the permanent version of the Trump tax cuts rather than just extending it for 8 years? I personally don't think that's going to happen. Meanwhile, all of this has to take place within the next 12 days or so. Why? Because back in December, the House and Senate approved a spending bill that would only extend government funding until March 14th, which is coming rapidly. If the House and Senate can't agree on the whole big, beautiful bill that Speaker Johnson is talking about, well, then they're going to have to come up with 12 separate budget allocations to fund the government. All of this by March 14th, or we may start seeing sections of or all of the government shutting down. One important part to mention in the House version of this budget is that the House extends the debt limit for $4 trillion more dollars. And another question then would be, well, just how long will that $4 trillion last? And I will get to that later in this video. Therefore, for those reasons, that is why I think that these bills that are maturing in late July and August have not gone up as high in yield at this point. However, I think that given the short amount of time, 11 days now, that the House and Senate have left to try to come up with a budget that they can agree on, this debt ceiling is going to start to play more into Treasury bills. Let's go back in time and look at what happened in 2023, the last time we faced this debt ceiling standoff. I would like you to pay attention to this subheadline here. Divergence between 1 month and 3 month bills is largest on record. And notice the date, April 2023. This headline here talks about the 4-week Treasury bill being at 3.31%. Meanwhile, the 13-week Treasury bill had got up to 5.105%. That's quite a divergence. However, a remarkable thing happened with the 4-week Treasury bill as we got closer to that X date in 2023, which was predicted to be June of 2023. We'll notice here that April 17th, the yield on the 4-week Treasury bill, 3.314%. However, within just a couple of weeks, the yield had spiked to 5.397%. That's because these bills were being sold such that they would be maturing around that early part of June. And we'll notice it went up even just a little higher to 5.5% by late May. Again, because these were Treasury bills that would be maturing within that X date range. Once some of this battle over the X date was concluded, we'll notice that this then came down significantly to 5.05%. What does this mean for your Treasury bills? Well, if you're looking to squeeze a little bit extra yield out of your Treasury bills, you may be looking at Treasury bills that would be maturing in this late July to early August timeframe. And after March 14th, if the debt ceiling standoff still has not been resolved, you may start to see some of these Treasury bills that will be maturing in this June timeframe, because that's, again, when that X date window kind of starts. We may start to see these Treasury bills in the June timeframe starting to increase their yield significantly. And as we get closer to May, if the debt ceiling standoff still has not been resolved, I expect to see, again, the 4-week Treasury bill yield spike, because those would be occurring during that potential X date window. I hope this was interesting and informative for you. If it was, please give us a thumbs up. And until next time, enjoy your investing.